If you look at the physical sciences, things like structural engineering or, I don't know, orbital mechanics, there is this really deep, comforting expectation of absolute precision.
Right, the math just inherently works.
Exactly. You drop an apple, and we know exactly how fast it's going to fall. We know it accelerates at 9.8 meters per second squared.
Every single time.
Every single time. And you build a suspension bridge, and the engineers can tell you the exact calculable amount of tension those steel cables will hold before they snap. It is a binary world, the math works, or the bridge falls down.
Yeah, it's a completely deterministic universe. And we naturally gravitate towards systems like that because, well, we like our rules to be visible. We want cause and effect to be locked together in a straight line.
But then you step into the world of macroeconomics.
Oh, boy.
Yeah, and suddenly you drop that metaphorical apple, and sometimes it floats. Or, sometimes it shoots sideways. Sometimes it just hangs there in midair for 3 years, completely defying gravity.
Which is incredibly frustrating to watch.
Because that economic apple is made out of human psychology, collective debt, political agendas, and just shifting expectations. We're looking at a system that is fundamentally murky.
It is the ultimate muddy water.
Mm.
And I think the frustration for so many people comes from trying to take clean theoretical models from a university textbook and, forcefully map them onto the chaotic, sweating, totally irrational reality of hundreds of millions of human beings making panicked financial decisions all at exactly the same time.
Which is exactly why we are here today. So welcome to this custom deep dive. Today, we are taking you, the listener, on a very specific journey into the hidden gears of the global economy.
And we have some fantastic source material to work through.
We do. We're working from a highly detailed analytical dossier that you provided to us. This stack of research covers the real mechanics behind macroeconomic cycles, the notorious yield curve, the actual anatomy of inflation, and crucially, how these massive invisible forces dictate the pricing of every asset you own.
So a lot to unpack.
It is. So our mission for today's deep dive is to decode these complex economic models. We want to translate them from theoretical academic jargon into a practical gravity system for your own portfolio.
Because here is the harsh reality. Whether you are actively trading options every single morning, or you are just letting your 401k sit untouched for 20 years, macroeconomics is the invisible gravity acting on every single dollar to your name.
It's always there.
Always. You can't see it, but it dictates how heavy or light your assets feel, how far your paycheck actually goes, and whether your retirement timeline is accelerating or slipping away from you.
And to really ground this conversation, we have to look at this through the lens of recent data. Right now, it is early 2026, and we are witnessing this incredibly delicate, almost precarious balancing act in the economy.
A very strange moment in time.
Yeah. If you look at the March 2026 data, the labor market is clearly cooling. U.S. unemployment ticked up slightly to 4.4%, and we saw 92,000 jobs lost in February. So you'd think things are slowing down.
Naturally, yes.
But on the exact same day, we are staring at this incredibly stubborn service inflation that absolutely refuses to die. I mean, everything from your car insurance to your dental bill is still just grinding upward. It's a paradox.
It's a massive paradox.
Right.
And to understand how we got trapped in this paradox, we have to start with the market's favorite and arguably most broken crystal ball.
The yield curve?
The government bond yield curve. If you walk onto any trading floor in the world, it is the most scrutinized line on the Bloomberg terminal.
Without a doubt.
And yet, if you ask 10 people to explain the mechanics of why it predicts what it predicts, I guarantee 8 of them will get it wrong.
So let's fix that right now. At its foundational level, all the yield curve does is draw a line connecting the interest rates of bonds with different maturity dates, right?
Exactly. So a 3-month bond, a 2-year bond, a 10-year bond. Assuming they're all issued by the same government, so the default risk is theoretically zero.
Okay, let's unpack this. It's basically a timeline of the cost of money. Let's build this from the ground up for someone who hasn't stared at a bond chart today. The curve basically has 3 resting states: normal, flat, and inverted.
Right.
In a healthy, humming economy, we see a normal curve, which slopes upwards. That means if I lend the government my money for 3 months, I get a lower interest rate than if I lock my money up for 10 years.
Which is entirely logical.
Right, because if I lock my cash in a box and hand the government the key for an entire decade, I am taking on a lot of unknown risk. Inflation could spike in year 4.
The currency could devalue.
Exactly. I need to be compensated for that darkness, that unknown future, so I demand a higher return.
That compensation is what institutional investors call the term premium. It's the extra yield required to stomach the anxiety of time. But there are two other drivers creating that upward slope.
What's the first one?
The short end of the curve, so the 1-month or 3-month yield, is almost entirely anchored by whatever the central bank is doing right now. In a normal expansion, the central bank keeps short-term rates relatively low to ensure businesses have cheap liquidity to grow, hire, and build factories.
So the short end is pinned down by the Fed's current policy, and the long end is drifting upward because of the term premium, but also because of growth expectations, right?
Yes,
So,
exactly.
like if the economy is recovering, the market assumes businesses will want to borrow more money in the future to expand. High future demand for loans means future interest rates will naturally have to rise.
That's the collective wisdom of the market, aggregating millions of data points. The long end of the curve arcs upwards because it reflects a bright, inflationary, growth-heavy future.
All right, so that is the sunny day scenario, but we aren't here to talk about sunny days.
No, we are not.
We need to talk about the thunderstorm, the inverted yield curve. This is the financial boogeyman.
It really is.
An inverted curve is when the short-term rates are actually higher than the long-term rates. The line slopes downward. Historically, this has been the ultimate leading indicator for an economic recession. How does this bizarre inversion physically happen?
It starts when the economy runs too hot. Inflation starts tearing through the system. The Federal Reserve looks at this and realizes they have to hit the brakes. So they adopt a tight monetary policy by violently hiking short-term benchmark interest rates.
Because they have to get things under control.
Right. And because those short-term bonds are tethered directly to the Fed's overnight rate, the short end of the yield curve gets violently yanked upward. Suddenly, a 3-month Treasury bill is paying 5% or 5.5%.
Now, intuition would say, well, if short-term rates are rocketing up to 5.5% because inflation is out of control, then long-term rates should shoot up to 7% or 8% to maintain that upward slope.
But they don't.
They don't. The long end of the curve actually drops below the short end. Why does a 10-year bond suddenly yield less than a 3-month bond?
Because of the behavior of what we call the smart money. Picture the massive institutional funds, the sovereign wealth portfolios, the pension funds that manage trillions of dollars. They aren't looking at today. They are modeling out 2, 3, 4 years from now.
They're looking ahead.
Exactly. They watch the central bank aggressively jacking up short-term rates, and they run their macroeconomic stress tests. And the output of those models tells them one thing. This violent tightening is going to break the economy's back.
They are essentially betting that the Fed is going to overplay its hand.
That is the core of the trade. They anticipate that the Fed will crush demand so severely that a recession is inevitable. And what happens when a recession hits?
The Fed panics.
Yes, they have to save the economy by slashing interest rates back down to zero.
Okay, I want to make sure I have this analogy right. Think of the short-term rate as the steering wheel of a car. The central bank is the driver gripping that wheel. They can jerk it left or right by hiking or cutting rates today, trying to dodge potholes. But the long-term rate, that is the headlights. The headlights illuminate the actual road ahead. They show where the collective market believes the car is going to end up, regardless of how aggressively the driver is wrestling the steering wheel right now.
I love that analogy. The headlights represent the probability-weighted discount of all future steering wheel movements. If the headlights are pointing down, it means the market sees a cliff approaching.
So what does a pension fund manager do if they see that cliff?
If they believe the Fed will be forced to slash rates to zero in the future, they want to lock in a guaranteed 4% yield for the next 10 years right now, while they still can.
So there is an absolute stampede into long-term bonds.
Literal gold rush. That massive surge in demand for 10-year and 30-year bonds drives the price of those bonds through the roof. And this is the iron law of fixed income. Bond prices and yields move in opposite directions.
So as the buying pressure crushes the price upward?
The yield gets mathematically crushed downward, pushing it below the short-term rate. The curve inverts.
And just for thoroughness, a flat yield curve is just the market being caught in transition, right? The tug of war is perfectly balanced.
Yes, a flat curve usually happens as we transition in or out of these extremes. You might see a bear flattener late in an economic cycle. The Fed is hiking short rates to kill inflation, but the market is starting to doubt the long-term growth story, so long rates refuse to rise at the same pace. The gap narrows until it's flat.
Okay, so we've established the textbook gravity of this indicator. If it inverts, pain is coming. But now we have to address the massive, glaring anomaly that has been driving every Wall Street analyst to the brink of madness over the last few years.
The great mystery.
Yeah. Between late 2022 and 2024, the yield curve experienced its deepest, longest continuous inversion in American history. It was flashing redder than it did before 2008 or 2001. Everyone swore a catastrophic recession was a mathematical certainty. Yet here we are in 2026. The sky hasn't fallen. So I have to represent the listener's skepticism here. If this alarm bell rang at maximum volume for 2 solid years and the house didn't burn down, is this indicator just fundamentally broken now, or did we just delay the fire?
It is the defining debate of our current macroeconomic era. Let me offer a slight chronological correction first, though. True economic recessions rarely trigger while the curve is actively inverted.
Oh, really?
Yeah, historically, the actual job loss recession hits 3 to 6 months after the curve uninverts and starts steepening again, which ominously is the exact window we find ourselves in now. However, your skepticism is deeply warranted.
Because nothing broke.
Exactly.
Yeah.
The U.S. economy absorbed an unbelievable amount of monetary tightening without immediately collapsing. The indicator isn't broken, but its predictive power was temporarily muted by 4 massive, historically unprecedented structural variables.
The dossier describes these 4 variables as effectively putting a suit of armor on the economy. Let's strip this armor down piece by piece. The first variable that blocked the recession is long-term locked-in debt. What did that look like in practice?
We have to travel back to the bizarre zero-interest rate environment of 2020 and 2021. The pandemic hits, the Fed drops rates to the floor, and money is essentially free.
Right.
During that specific window, American households and mega corporations executed the largest, most aggressive debt refinancing event in the history of modern finance.
If you're listening to this and you owned a home in 2020, you know exactly what this felt like. You were probably sitting at your kitchen table, clicking a few buttons on a lender's website, and suddenly your 30-year mortgage was locked in at 2.8%.
And you weren't alone. Corporations were doing the exact same thing, but with billions of dollars. They issued massive amounts of 5 to 10-year corporate bonds at incredibly low fixed rates.
So fast forward to 2022 and 2023.
The Fed realizes inflation is rampant and suddenly jacks up short-term benchmark rates past 5%. Historically, this would choke the economy instantly. But this time, it was like the Fed was throwing haymakers at a brick wall.
Because the pain of high interest rates only hurts if you actually need to borrow new money or if you have a variable rate loan that adjusts upward. But if your debt is locked in for 30 years, the Fed can raise rates to 15% and your monthly mortgage payment doesn't change by a single cent.
Precisely. The vast majority of the productive economy had secured a fixed-rate immunity shield. The traditional transmission mechanism, where high rates immediately crush consumer spending, was completely severed by this barrier of cheap, long-term debt.
That brings us to variable number 2, which sounds almost rebellious: fiscal dominance. This implies that while the central bank was trying to slow things down, the federal government was actively fighting them.
In a standard economic textbook, monetary policy, which is the Fed, and fiscal policy, which is the government, work in tandem. When the central bank hits the brakes to cool the economy, the government usually tightens its belt and cuts spending too.
Right, they coordinate.
But this cycle broke the mold. We saw an extreme historic divergence.
The Fed was desperately trying to drain liquidity from the bottom of the pool, right? They wanted to dry things up.
But while the Fed was draining the pool, the federal government backed up a fleet of fire hoses and started pumping cash directly into the top. Even though we were technically in peacetime, the government was running massive structural deficits that looked like wartime spending.
Wow.
Through massive legislative packages like the Chief PS Act, the Infrastructure Bill, the Inflation Reduction Act, trillions of dollars were being injected directly into domestic manufacturing and green energy projects.
So if you're a construction company or a semiconductor engineer, the Fed is telling you, hey, money is tight, but the government just handed your sector a $50 billion grant. You're going to keep hiring. You're going to keep expanding.
The government's targeted investments translated directly into high-paying jobs and sustained corporate profits. This tidal wave of fiscal liquidity forcefully overwhelmed the tightening pressure created by the Fed's high interest rates. The government essentially bought the economy's way out of a short-term recession.
Which leads perfectly into the third variable blocking the recession: labor hoarding. Now, this one fascinates me because it's not a mathematical formula. It's pure human psychology. It's corporate trauma.
Trauma is the exact right word. Think back to the post-pandemic reopening phase. Restaurants, Logistics companies, tech firms, they all face severe labor shortages. Companies simply could not find bodies to do the work.
They had to offer massive signing bonuses, raise wages, and basically beg people to come back.
Yes, and that painful, expensive experience fundamentally rewired corporate behavior.
Because historically, the moment a CEO sees interest rates rise and sales start to dip, their very first reflex is to protect their profit margin by executing mass layoffs. Labor is the easiest cost to cut.
But this time, that HR director walked into the CEO's office and said, look, if we fire these skilled software engineers or these specialized factory workers right now just to save a few bucks this quarter, it's going to take us 2 years and twice the salary to hire them back when the economy inevitably recovers.
They're terrified of losing them.
Exactly. We can't afford to lose them.
So they looked at the rising rates and chose to willingly sacrifice their short-term profit margins just to hoard their workforce.
They kept people on the payroll even when demand softened. And if we look at the macro picture, personal consumption makes up 70% of the entire U.S. GDP. As long as people wake up and have a job to go to, they don't panic. They keep paying their mortgages, they keep buying groceries, they keep going to the movies.
So labor hoarding meant employment stayed incredibly resilient, which is why unemployment has only gently drifted to 4.4% now in 2026. Without mass job losses, the consumer engine never stalled out.
Exactly right.
And the final piece of armor the dossier points out is supply-side repair.
Which was the ultimate relief valve. Historically, if inflation is running hot, the only tool the Fed really has is demand destruction. That is a polite academic way of saying you have to intentionally cause a recession so people become too poor to buy things, which forces businesses to lower prices.
Brutal.
Very. But this time, inflation naturally cooled down on its own because the physical world healed.
You're talking about the container ships parked outside the ports finally getting unloaded.
The global supply chains unkinked.
Oh.
Microchips started flowing into car factories again, so the price of used cars plummeted. Plus, a massive surge in post-pandemic immigration rapidly expanded the labor pool, which naturally cooled down the frantic wage growth without requiring the Fed to induce millions of layoffs.
Right.
The supply side fixed itself, meaning the Fed didn't have to absolutely nuke the demand side to get inflation trending downward.
This is a wild scenario. We have an economy wearing a bulletproof vest of low-interest debt, getting pumped full of adrenaline by government spending, while hoarding its workers out of pure fear. If this armor is what delayed the pain of the inverted yield curve, it really begs the question, how are the Fed's policies supposed to hurt us? How does turning a dial in Washington actually slow down a factory in Ohio?
That is the perfect pivot. We need to look under the hood at the actual engine mechanics. In macroeconomics, this sequence of gears is called the monetary policy transmission mechanism.
Let's not just list these channels off like a textbook. Let's build a real-world scenario. Let's imagine a mid-sized, privately owned manufacturing company. Let's call them Acme Corp. They make specialized metal parts in Ohio. The Fed hikes rates. How do the four gears of this transmission mechanism simultaneously squeeze Acme Corp until they stop spending money? Let's start with the most obvious one, the interest rate channel.
The Fed raises the benchmark rate. This instantly pushes up the overnight borrowing costs for the commercial banks.
Yeah.
The banks, naturally, pass this higher cost onto their customers. So the CEO of Acme Corp goes to their local bank to take out a $5 million loan to build a new warehouse. 2 years ago, that loan was 4%. Today, the bank manager says it's 9%.
Ouch!
Right. The CEO runs the math, realizes the new warehouse will never generate enough profit to cover 9% interest rate, and cancels the project. The construction workers don't get hired. The concrete doesn't get bought. Demand vanishes.
That's the direct hit. Now let's weave in the second gear, the asset price channel, which economists often call the wealth effect. This one hits the psychology of Acme's leadership.
Yes. When the Fed hikes rates, the return on guaranteed risk-free government bonds goes up. This mathematically alters the discount rate used to value risky assets. So over the course of a few months, the stock market drops 15% and commercial real estate valuations plummet. The CEO of Acme Corp logs into their personal brokerage account and sees their retirement portfolio is down $500,000. The value of their existing factory building has dropped.
So even if the CEO's actual salary hasn't changed by a single dime, they feel significantly poorer. They feel vulnerable. So instead of buying that new fleet of company cars or authorizing end-of-year bonuses, they tighten their belt. That psychological negative wealth effect sucks even more demand out of the economy.
Absolutely.
Okay, gear 3, the credit channel. This is where the bank itself starts getting scared, right?
Exactly. The local bank manager isn't just looking at the Fed's rates. They're looking at the local economy slowing down. They see Acme Corp canceling the warehouse. They see other businesses struggling. The bank realizes the risk of loan defaults is rising. So the bank doesn't just charge a higher interest rate. They actively tighten their lending standards. They become incredibly stingy.
So what do they do to Acme?
They might tell Acme Corp, we aren't just raising the rate on your revolving credit line. We are cutting your credit limit in half because we don't trust the economic environment.
Wow. Acme is suddenly starved of liquid cash and is forced to halt all expansion or even lay off workers just to make payroll.
Yep.
And the final gear squeezing Acme Corp is the exchange rate channel. And I want to pause here because the dossier explicitly highlights a massive misconception about this channel that trips up even seasoned investors. Walk us through how currency fluctuation hurts Acme.
When the U.S. Federal Reserve raises rates significantly higher and faster than, say, the European Central Bank, U.S. government bonds offer a much more attractive yield than European bonds. So international capital floods into the United States, chasing those high yields. To buy those U.S. bonds, foreign investors have to buy U.S. dollars.
And that drives the price up.
Yes, that massive demand causes the value of the U.S. dollar to appreciate sharply against the euro.
Now, a strong dollar sounds great if I'm an American taking a vacation in Paris. My money goes further. But for Acme Cord making metal parts in Ohio,
It's a disaster because suddenly those metal parts cost 20% more for their buyers in Germany simply because of the exchange rate. The German buyers say, this is too expensive, and they switch to a local supplier. Acme's exports plummet.
but here is the critical misconception the dossier warns about. Many people look at Acme exporting less and conclude, aggregate supply in the economy is falling.
And that's the trap.
People think because the factory is shipping fewer boxes, the nation's supply is shrinking.
But that's fundamentally incorrect.
Yeah.
Acme's factory is perfectly fine. The machines work. They have the capacity to supply. The issue is that nobody wants to buy the parts at that inflated currency price. A drop in net exports is a direct, mathematically painful subtraction from aggregate demand. The global desire to purchase American goods has evaporated.
So Acme Corp gets hit by all four gears. The loan is too expensive, the CEO feels poor, the bank cuts their credit line, and their foreign buyers vanish. That is how the Fed's dial in Washington crushes demand. But the dossier makes a really technical distinction here that we have to unpack. When we talk about the Fed tightening, we hear two different terms: quantitative tightening, or QT, and rate hikes. A lot of financial news anchors use these interchangeably, but they attack the banks in completely different ways, don't they?
They are entirely different mechanisms. It's the difference between taking away a bank's physical capacity to lend versus altering their psychological desire to lend.
Okay, let's start with quantitative tightening, or QT.
This is a physical drain on the plumbing of the financial system. During QT, the Fed shrinks its balance sheet. When the government bonds they hold mature, the Fed doesn't reinvest the money, or they might actively sell bonds into the market.
Where does the money to buy those bonds come from?
It is pulled directly out of the commercial banking system's reserve accounts. That's the cash that commercial banks are required to hold at the Fed. And when the Fed pulls that money out, it is mathematically destroyed. It ceases to exist.
Wow, it just vanishes.
Yes. So QT physically drains the absolute amount of excess cash in the system. It literally takes the bullets out of the bank's gun. They have less money to lend, period.
So QT limits their capacity. What about rate hikes?
Rate hikes alter the chemistry of motivation. When the Fed raises its benchmark rate, what they're actually doing is increasing the interest on reserve balances, or IORB. Let's say they set the IORB at 5.4%. This means a commercial bank can take whatever excess cash it has left, park it safely at the Federal Reserve overnight, and earn a guaranteed, risk-free 5.4% annualized return.
So the bank manager is sitting at his desk, earning 5.4% for doing absolutely nothing, and in walks the CEO of Acme Corp asking for a loan.
Right. And the bank manager looks at the slowing economy, looks at Acme's falling exports, and assesses the risk that Acme might default. Why on earth would the bank manager take on the heavy risk of lending to a struggling business at 7% or 8% when they can get a guaranteed, pristine 5.4% from the government while sleeping soundly?
They wouldn't. The opportunity cost is just too high. So rate hikes destroy the bank's subjective willingness to lend. QT takes the bullets out of the gun, and rate hikes make the bank not want to pull the trigger anyway. Together, they engineer a systemic credit crunch.
At least that is how it's supposed to work in theory.
Right. And this brings us back to the armor we talked about earlier. In this specific cycle, this perfect elegant transmission mechanism got brutally jammed. If you're listening to this, I want you to think about this analogy. The Fed's policy right now feels like stomping on the brakes in a car, but realizing the brake pads are coated in a thick layer of grease.
That's the way to put it.
The Fed's foot is pinned to the floor, rates are at 5.5%, but the friction just isn't reaching the actual wheels of the economy. We've talked about the mortgages, but I really want to dive into the most insane revelation in this dossier. It's the part where the Fed's attempt to hurt the wealthy actually made them richer.
It is arguably one of the most perverse unintended consequences in modern monetary history, and it all stems from that grease on the brake pads. Let's look at a wealthy household or a large, high-quality tech corporation. During the 2020 era, they locked in all their long-term debt at roughly 3%. But because they are wealthy or highly profitable, they also have massive piles of cash reserves sitting around.
Okay, so they have a $500,000 mortgage at 3%, and they have $200,000 in a savings account. Or a corporation has $1 billion in debt at 3% and $2 billion in cash.
Exactly. Now, the Fed violently hikes benchmark rates to 5.5% to cause pain. What do these immune players do? They don't have to refinance the 3% debt. Instead, they take their massive piles of cash and they move it out of zero-interest checking accounts and put it into money market funds or short-term treasury bills that are now yielding 5.5%.
So they are paying the bank 3% on their borrowed money, but the government is paying them 5.5% on their cash, completely risk-free.
They were earning a positive spread of 2.5% just for existing. The mechanics are staggering. The Federal Reserve aggressively hiked rates with the explicit intention of draining liquidity, tightening belts, and making people feel poorer so they would stop spending.
But it backfired.
Massively. For this specific, highly capitalized demographic, the rate hikes actually increased their net wealth and disposable income through massive interest income.
The Fed accidentally created a universal basic income program for the rich.
In functional terms, yes. The tight monetary policy inadvertently became a massive stimulus program for those who already had healthy cash-rich balance sheets. This is the exact reason why the U.S. consumer has shown such baffling resilience, why luxury travel is still booming, and why high-end restaurants are still fully booked. The transmission mechanism was completely inverted for a huge swath of capital.
That is genuinely mind-boggling. And it explains so much of the friction we are seeing today. Because the Fed's brakes are slipping so badly on the wealthy, they've had to keep rates higher for much longer than anyone anticipated, hoping that eventually the friction catches somewhere. But what exactly is the Fed trying to break at this point? If goods prices have stabilized, what is the core enemy in early 2026?
To defeat the enemy, you have to dissect it. The public talks about inflation as if it's a single monolithic blob. It is not. Inflation has three distinct independent drivers: demand pull, cost push, and credit expansion.
Let's separate those out because they require completely different medicines. Demand pull is the classic too much money chasing too few goods scenario.
Exactly. Picture an economy running red hot. Unemployment is at record lows, everyone has multiple job offers, wages are high, consumers feel invincible, so they rush out to buy a new car.
And everyone else does too.
Yeah, right. But the factories can only produce so many cars per day. When 10 people show up at the dealership to buy the same one car, the dealer simply raises the price. The excess consumer demand physically pulls prices upward.
And cost push is the darker flip side of that. The consumer isn't going crazy, but the price goes up anyway.
Cost push originates purely on the supply side. Imagine the consumer is completely financially stable, not overspending at all. But suddenly, a geopolitical crisis erupts in the Middle East, and the global price of crude oil triples.
Oh, that changes everything.
It does. Every factory on Earth that relies on oil to run its machines or diesel to ship its products suddenly faces a massive spike in operating costs. To prevent themselves from going bankrupt, these companies must aggressively push those increased costs onto the final consumer.
You walk into the grocery store and the apple costs more, not because everyone suddenly loves apples, but because the diesel in the delivery truck doubled in price.
Precisely. And the third driver, credit expansion, is the invisible accelerant. When banks are lending freely and reserve requirements are low, the banking sector essentially creates new money out of thin air via loans.
This rapidly expands the total money supply in the system.
And all that fresh liquidity chases assets: housing, stocks, crypto. It bids up their prices. This creates an artificial wealth effect that eventually spills over into everyday consumer prices.
Okay, so those are the three engines of inflation. But the dossier splits the results of those engines into two wildly different categories that are behaving very differently right now: goods inflation and services inflation. Talk to me about goods inflation. Where are we with the price of tangible stuff?
Goods inflation. The price of physical, tangible items like washing machines, flat-screen TVs, clothing, and even used cars has largely flatlined. In fact, over several recent months, we have actually seen persistent deflation in this category.
Is that because the Fed's high interest rates finally crushed consumer demand for physical goods?
Partly, but the heavy lifting was actually done by the supply side. The global manufacturing supply chains that were shattered during COVID have completely healed. Cargo ships are moving efficiently,
Which is huge.
but more importantly, physical goods are highly tradable. If a television manufactured in the United States becomes too expensive because of local labor costs, a retailer can simply log onto a terminal and import a cheaper television from Mexico, Vietnam, or Bangladesh. This fierce, globalized price arbitrage constantly puts a hard lid on how much domestic goods inflation can rise.
But then we flip the coin to the other side: services inflation. Things like your monthly rent, your medical copays, the mechanic fixing your transmission, your local barber. This is the monster that is refusing to die. And the dossier introduces a very specific, almost intimidating metric that the Federal Reserve is obsessively tracking right now. It's called supercore inflation. What exactly makes it supercore?
Supercore inflation is a very surgical metric. It is defined as core services inflation, excluding housing.
Now, hold on. If I'm listening to this, I'm thinking, my rent or my mortgage is the single biggest line item in my entire monthly budget. It's easily 30% to 40% of my spending. Why on earth would the Federal Reserve intentionally exclude the most important expense from their primary inflation metric?
It sounds absurd on the surface, but they aren't ignoring its importance to your wallet. They are ignoring it for the sake of making real-time monetary policy decisions because of a massive statistical illusion.
An illusion? How so?
Housing data in the official Consumer Price Index is primarily based on 12-month rental contracts. Let's say the economy crashes today and a landlord lowers the asking rent on an empty apartment by 20% this afternoon. The official CPI data will barely register that drop.
Wait, why not? If rents dropped, shouldn't inflation drop?
Because the CPI is averaging in the millions of existing tenants who are stuck in the middle of a 12-month lease they signed 6 months ago at peak prices. The official data won't reflect today's actual spot market rent drop until millions of those old leases slowly expire and renew over the next year.
Ah, so housing data is essentially looking in the rearview mirror. It tells you what inflation was doing 6 months ago, not what it's doing today.
Exactly.
Ugh.
If you are the chairman of the Federal Reserve and you need to decide whether to hike interest rates tomorrow morning, you cannot base that decision on lagged data. If they want to know the current real-time temperature of domestic inflation, they have to strip out the lagging housing data.
And they have to strip out the globally manipulated goods data.
Right. What you are left with is the pure, unadulterated reality of the domestic labor market.
Yeah.
That is supercore, domestic, labor-intensive, non-tradable services.
Here's where it gets really interesting. Think about your own budget for a second. Think about how much of your life is consumed by supercore items. Car insurance premiums have skyrocketed because mechanics charge more per hour. Daycare costs are astronomical. A trip to the local dentist. These are non-tradable services.
You can't outsource them.
Exactly. If my tooth hurts in Chicago, I cannot import a cheaper dental filling from Vietnam to arbitrage the price. I have to pay the prevailing wage of a dentist in Chicago. This is what makes supercore inflation feel so deeply personal, so inescapable, and so incredibly sticky. Why is it so structurally difficult to bring service prices down?
The stickiness is built into the bedrock of human labor. First, you have severe wage rigidity. If you run a service business, say a consulting firm or a landscaping company, the absolute vast majority of your operating cost is your payroll. During an inflationary boom, you have to raise your employees' wages just to keep them from quitting.
Because everyone is hiring.
Right. But here is the trap. While a business can freeze hiring, it is practically impossible to actively cut a worker's hourly pay once it has gone up. Labor laws, union contracts, and basic human morale prevent wages from smoothly adjusting downwards. You try to cut your staff's pay by 10%, they walk out. So once the baseline cost of human labor rises, the floor for service prices is permanently elevated.
And the dossier introduces a concept here that I absolutely love because it perfectly illustrates why service prices are doomed to just keep grinding higher forever. It's called Baumol's cost disease. We need to spend some time on this.
William Baumol was a brilliant economist who noticed a profound structural discrepancy in how the economy evolves. If you look at the manufacturing sector, you see a history of exponential leaps in productivity driven by technology.
Like Henry Ford's assembly line.
Exactly. 100 years ago, a factory full of workers took weeks to assemble a single automobile by hand. Today, with advanced robotics, precision lasers, and AI supply chain management, a much smaller team can assemble a vastly superior car in a matter of hours. The amount of human labor required per car plummets.
That makes sense.
This incredible efficiency allows the car company to pay their remaining workers a much higher wage, while simultaneously keeping the final price of the car relatively stable for the consumer.
But you cannot apply that technological leverage to most human services. The classic example Baumol used was a string quartet. It takes four musicians exactly the same amount of time, say 40 minutes, to play a Beethoven string quartet today, as it took four musicians to play it in the year 1850.
There's no robotic shortcut. There's no exponential productivity leap.
That is the core of Baumol's cost disease. A barber still takes 30 minutes to cut your hair. A nurse still has to spend 30 minutes taking your vitals and listening to your symptoms. The labor productivity is stagnant.
But, and here's the critical economic pivot, the barber, the nurse, and the musician still have to pay the same rent and buy the same groceries as the guy working at the highly efficient robot car factory.
Because they all live in the same economy.
Exactly. Because the service sector must compete with the tech and manufacturing sectors for the same pool of human labor, service businesses are forced to continually raise wages just to retain their staff.
But because the barber isn't cutting hair any faster, that wage increase cannot be offset by higher volume or efficiency. Therefore, 100% of that wage increase must be passed directly onto you, the consumer, in the form of a more expensive haircut.
Exactly. Service inflation is structurally sticky because it is chained to the rising cost of living without the relief valve of technological efficiency.
Which brings us back to the reality check of early 2026. We mentioned earlier that U.S. unemployment ticked up to 4.4% and 92,000 jobs were lost. To the average person, that sounds like terrible news. But to the Federal Reserve, this is actually their master plan finally working, isn't it?
What's fascinating here is that this softening in the labor market is their deliberate attempt to cool down the demand for these services, which hopefully cools down the wage demands and finally breaks the back of supercore inflation.
That is the exact brutal mechanism. Supercore inflation isn't just an economic metric to the Fed. It is a real-time thermometer for the most dangerous contagion in economics, the wage price spiral.
If wages keep going up, service prices keep going up, which makes workers immediately demand higher wages to afford the services. The Fed's only blunt instrument to break that feedback loop is to cool the labor market.
And if they fail to break that loop, if supercore inflation stays hot and the labor market refuses to crack, the Fed faces an absolute nightmare scenario where inflation expectations become completely unanchored. And this leads us directly into the darkest chapter of macroeconomics, the runaway spiral and the Fed's brutal math.
It's a dark chapter indeed.
We hear this term wage price spiral thrown around on financial news networks all the time. How does a little bit of sticky service inflation mutate into a runaway societal spiral?
A runaway inflation spiral happens when inflation fundamentally changes its nature. It stops being a mathematical reaction to physical supply shortages, and it becomes a psychological contagion. It's the moment when inflation expectations completely detach from reality.
Give me an example of how that plays out.
Let's say consumers look at the trajectory of the last 2 years and start believing deeply in their bones that prices will simply always be higher tomorrow than they are today. What is the rational response? You rush to buy things today. You hoard. You buy 3 washing machines because you think they will cost double next year.
And this massive artificial surge in panic buying demand physically pushes prices up, validating the fear.
Yes. And then the workers, seeing the prices at the grocery store rising every single week, march into their boss's office and demand massive 15% or 20% wage hikes just to ensure they don't starve next year.
And the companies, looking at their soaring labor costs and their soaring raw material costs, aggressively raise the final prices of their products to protect their margins.
And when the consumer walks into the store the next day and sees that higher price tag, it perfectly validates their initial fear that prices were going up. The expectation becomes a self-fulfilling prophecy.
You get caught in an endless, accelerating loop. Prices rise, wages rise to catch up, production costs rise, prices rise again. It completely detaches from the actual supply and demand of the real economy.
And if this cycle isn't forcefully broken, it leads to hyperinflation. The dossier outlines the destructive nature of this, and it's terrifying. It's not just that everyday items get incredibly expensive. A runaway spiral fundamentally destroys what fiat money actually is.
It destroys the illusion of money.
Yes, we have to remember that fiat money, like the US dollar, the euro, or the yen, has no intrinsic value. It is not backed by gold. It is a piece of paper or a digital ledger entry that is entirely backed by collective societal trust.
So what happens to that trust?
In economic theory, money has three core functions. It is a medium of exchange, a unit of account, and a store of value. In a hyperinflationary spiral, that third function, the store of value, dies instantly. If you know that your cash in the bank will lose 10% of its purchasing power by next Tuesday, you will absolutely not hold it.
You will dump your cash the very second your paycheck clears.
You will buy hard assets, real estate, gold, foreign currency, or even basic commodities like non-perishable food just to preserve your labor's worth.
The dossier mentions a phrase here that I want to highlight. Money velocity approaches infinity, meaning a single $20 bill changes hands dozens of times a single day because nobody wants to be the one caught holding it when the music stops. It's a massive societal game of hot potato.
And mathematically, when the velocity of money explodes like that, the central bank completely loses control. Even if the Fed completely stops printing new money, prices will still rise exponentially simply because the existing money is moving so frantically.
The complex credit networks that allow modern society to function just collapse.
Nobody will sign a 5-year business contract or offer a 30-year mortgage in a currency that is melting like an ice cube on a hot sidewalk.
But the true tragedy of this spiral isn't the macroeconomic theory. It's who it actually hurts on the ground. The dossier calls it the systemic deprivation of the lower and middle class. This is the invisible tax. Let's unpack the asymmetry here. Who wins and who loses in a runaway spiral?
Inflation is arguably the most efficient mechanism for upward wealth redistribution ever created. Let's look at the wealthy class first. The vast majority of their net worth is not sitting in cash. It is stored in hard, productive assets. They own real estate, they own equity in businesses, they own vast stock portfolios.
So when inflation hits,
During an inflation spiral, the nominal dollar value price of these hard assets skyrockets right alongside the inflation rate. Their wealth is naturally insulated. The numerical value of their portfolio scales up to match the devaluation of the currency.
but the lower income demographic, their reality is entirely different. Their wealth, if they have any, is almost entirely held in cash checking accounts, or perhaps fixed income pensions, and their daily survival relies on fixed hourly wages.
And as we discussed with wage rigidity, wages always lag far behind the daily price hikes at the grocery store.
Exactly. The working class is essentially paying a massive, invisible, unlegislated tax. Every single day they wait for their annual performance review to beg for a 4% raise. The cost of their rent, food, and energy has already gone up 12%.
Their actual physical survival purchasing power is systematically stripped away and transferred to the asset-owning class. It hollows out the middle of the country.
Which brings us to the big, incredibly uncomfortable question of this entire deep dive. We know the Fed aggressively hikes rates, fully knowing it will choke businesses. They know it will cause bankruptcies. They know it will force companies to lay off hundreds of thousands of workers. Why? Why would a group of unelected economists sitting in Washington intentionally inflict that kind of devastating, localized pain on the American public?
This raises an important question, because they're trapped in what economists call a constrained optimization problem. They do not have good choices. They have to choose between two profound existential evils. A recession caused by high interest rates is a temporary cyclical pain. It is brutal on the families who lose their jobs, absolutely. But macroeconomically, it is a natural, necessary part of the capitalist cycle that forcefully clears out bad, inefficient debt and zombie companies.
Once the system is purged and prices reset, the central bank can cut rates and the economy rebuilds. It is painful, but it is reversible.
Right.
And the other evil...
The other evil is the runaway inflation spiral. That is a systemic cancer. If inflation expectations become permanently entrenched in the psychology of the public, it destroys the entire foundation of the fiat currency. You risk complete societal instability, political upheaval, and total economic collapse.
So the Fed relies on a cold mathematical formula called the sacrifice ratio.
Yes, the sacrifice ratio calculates exactly how much GDP you have to actively destroy, how many jobs you have to kill to lower inflation by just 1%. The Fed's internal models, heavily influenced by history, show a terrifying truth. Acting early and aggressively is vastly, exponentially cheaper than waiting.
If you hesitate.
If you hesitate and inflation becomes psychologically entrenched, fixing it later requires absolute devastation. Think of Paul Volcker, the Fed chairman in the early 1980s. Inflation had spiraled out of control for a decade. To break it, Volcker had to jack interest rates up to nearly 20%. He intentionally triggered a massive, crushing recession. Farmers were driving their tractors to Washington to protest.
Wow. But he had to do it.
He had to. The Fed today looks at that history and knows that triggering some demand destruction, meaning unemployment, early on is the only mathematical way to prevent a systemic collapse later.
I want to push back on this on behalf of the listener because the language used around this is so sanitized. When the current Fed chairman goes on TV, sitting in a nice suit, and calmly talks about the need for below-trend growth or softening labor conditions, he is literally saying to the camera, we need some of you watching this broadcast to lose your livelihoods so we can save the broader financial system. That sounds incredibly harsh. It sounds almost cruel.
You've hit on the core irony of central bank communication. You are entirely correct. Central bankers must manage public panic, so they wrap their actions in highly sanitized academic speak. But when you translate restoring balance to the labor market, the stark, unvarnished reality is demand destruction.
They are deliberately raising the cost of capital so companies cannot afford to expand.
They want to force those companies to lay people off. They want those unemployed people to stop buying discretionary items. And they want that drop in consumer spending to force businesses to lower their prices out of desperation. It is a brutal, calculated human sacrifice to preserve the integrity of the currency.
That is a sobering reality. And when the smartest, most ruthless investors in the world, the smart money we talked about earlier, when they run their models and realize that the Fed is fully willing to crash the economy and induce job losses to save the currency, they start making massive, counterintuitive bets in the bond market. And this perfectly sets up the next crucial phase of our discussion, the bond market paradox.
This is where abstract macro theory translates into multi-billion-dollar high-stakes trades.
Let's lay out the paradox clearly, because on the surface, it makes absolutely no sense. Let's look at the yield curve right now. Short-term government bonds, like a 3-month treasury bill, are yielding roughly 5.5%.
Right.
At the exact same time, long-term bonds, like the 10-year treasury, are yielding only 4%. Now, any rational listener looking at a standard savings account would say, I want the 5.5%, why would I take less money? But the smart money, the huge hedge funds and institutional players, they ignore the 5.5% and pour billions of dollars into buying the 4% bond. Why on earth would the smartest guys in the room willingly accept a lower yield when they are anticipating a recession?
Because they aren't looking at the yield today. They are managing risk over a timeline. The answer lies in 2 words: reinvestment risk.
Okay. Unpack the mechanics of that risk for me.
That 5.5% yield on the 3-month bond is essentially a limited time trial. It feels great for 90 days. You collect your high interest. But what happens on day 91?
The bond matures.
The bond matures. The U.S. government hands you your principal cash back, and now you have to reinvest it. If the smart money is right about the macro environment, if a recession hits and forces the Fed to panic and slash rates, you are now sitting on a massive pile of cash in a world where short-term rates have suddenly plummeted to 2%. You are stuck reinvesting your capital at a terrible rate for years to come.
So the 5.5% was a mirage. But if I bought the 10-year bond at 4%, well...
You locked the door and swallowed the key. You secured a solid, guaranteed baseline yield of 4% for an entire decade, regardless of whether the Fed drops short-term rates to 0 tomorrow. You have completely eliminated your reinvestment risk.
That makes perfect sense for protecting steady cash flow. But the dossier reveals a much deeper, much more aggressive motive. Locking in the 4% isn't actually how these massive hedge funds make their real money. They don't want to sit around for 10 years clipping coupons. The real moneymaker is duration and capital gains. We need to explain the math behind this, because this is where Wall Street fortunes are made.
To understand this trade, you must memorize the golden rule of fixed income. Bond prices move inversely to yields. When yields go down, the physical price of the bond goes up. Now, let's introduce the concept of duration, which is essentially a mathematical measure of how intensely sensitive a bond's price is to changes in interest rates.
Think of duration like a giant seesaw. If you buy a 3-month bond, you are sitting right next to the center fulcrum of the seesaw. If interest rates move up or down, you barely feel a bump. Your price stays relatively stable, but if you buy a 30-year bond, you are sitting at the very end of a 30-foot-long seesaw.
That is a perfect visualization. The 30-year bond has massive duration, which acts as embedded leverage. The math is roughly this. The percentage change in the bond's price equals the negative of its duration multiplied by the change in yield. So if a hedge fund buys a 30-year bond yielding 4%, and a recession hits, forcing the Fed to cut rates rapidly, driving the 30-year yield down to 2%.
That's just a 2% drop in yield at the center of the seesaw. But what happens to the guy sitting at the end of the 30-foot seesaw? What happens to the price of that bond?
Because of the massive duration multiplier, the price of that bond could violently skyrocket by 30% to 40% almost instantly. These hedge fund managers aren't buying the 30-year bond to slowly collect a 4% yield until they retire. They were buying it as a highly leveraged macro trade. They want to hold it for 6 months, watch the Fed panic and cut rates, see the bond price explode upward, and then immediately sell the bond to someone else for a 30% capital gain.
That is a brilliant, ruthless trade. But wait, I have to push back here, because this relies entirely on a concept that always confuses people. This trade only works if the yield on existing bonds drops when the Fed cuts rates. The dossier brings up the no arbitrage principle to explain this. Let's say I bought a bond last year that physically states on the paper it pays 5%. The ink is dry. It's a legal contract. Tomorrow the Fed cuts rates, and the government is only issuing brand new bonds that pay 3%. Why doesn't my old bond just keep yielding 5%? How can a rate cut change a contract I already signed?
This is the crux of bond market mechanics. Your old bond does keep paying the exact same fixed dollar amount of interest. The physical coupon payment never changes. If it pays $5 a year, it will always pay $5 a year. What changes is the market price of your bond if you try to sell it. And it changes precisely because of the no arbitrage principle.
Walk me through a scenario. Prove to me why the price has to change.
Imagine the Fed cuts rates today. Anyone walking into the market to buy a brand new bond is only getting 3%. But you are sitting there holding an old bond that pays $5 a year on a $100 face value. That's 5%. Every single rational investor on Wall Street will look at the new 3% bonds, throw them in the trash, and say, I want to buy that guy's 5% bond.
So a massive, desperate wave of capital rushes to buy my specific old bond.
Precisely. The demand for your specific bond is overwhelming. So you aren't going to sell it to them for $100. The price of your old bond gets bid up in the open market. People offer you $105, then $110, then $117 for your $100 bond. Now, think about the math for the guy who finally buys your bond for $117. He is still only getting that fixed $5 a year in interest. And when the bond finally matures in 10 years, the U.S. government is only going to give him back the $100 face value. He is mathematically guaranteed to lose $17 of capital on the maturity date.
Oh, I see it. If you take the $5 annual interest he earns every year, but you subtract the $17 capital loss he is guaranteed to take at the very end, his actual effective yield on the money he invested gets diluted.
Yes. The open market will bid up the purchase price of your old bond until the high buying price mathematically dilutes the effective yield down to exactly 3%, perfectly matching the new bonds. That is the no arbitrage principle. The market will never allow two identical risk profiles to offer different returns. It violently forces the secondary market to immediately reflect the new macro reality.
I love this. I liken it to holding a rent-controlled apartment lease in a booming tech city. The apartment itself hasn't changed. The plumbing is the same. But if the market rent for all the new luxury apartments around it suddenly skyrockets to $4,000 a month, the value of holding your specific rent-controlled lease, your old bond, locking in $1,000 a month, shoots through the roof. People would pay you a massive upfront premium just to take over your favorable terms.
A perfect analogy. And this depth of market mechanics brings up one final cynical point from the dossier regarding how the bond market operates. Sometimes listeners who lean toward conspiracy theories ask, when the Treasury issues new bonds, why can't the big Wall Street banks just form a cartel? Why can't the 20 biggest banks secretly agree to demand a 5% yield from the government at auction, even if the secondary market is trading at 3%? They have all the money. Why don't they hold the government hostage?
Right. It seems like an easy cartel to form. Why doesn't that happen?
Because human greed is a stronger force than collusion. It is prevented by game theory, specifically the classic prisoner's dilemma, combined with the overwhelming depth of global liquidity. Let's play it out. Let's say 24 major global banks meet in a smoky room and secretly agree to demand a 5% yield at tomorrow's treasury auction. The fatal flaw is that every single bank in that room knows that the secondary market is currently trading at 3%.
So they know there is a 2% gap between their artificial demand and reality.
Exactly. Now, if just one single bank decides to betray the cartel and bid 4.9%, they will win the entire multi-billion-dollar auction. And because the secondary market is trading at 3%, that betraying bank can immediately turn around and sell those newly won 4.9% bonds into the secondary market, pocketing a massive risk-free arbitrage profit worth billions of dollars in a single afternoon.
Because the financial incentive to betray the group and take the guaranteed billions is so astronomical, the collusion collapses before it even starts. Everyone tries to front-run everyone else to get the arbitrage, and the auction yield gets driven right back down to match the 3% secondary market.
Game theory guarantees market efficiency here. Furthermore, the market isn't just those 24 banks. You have foreign central banks, massive state pension funds, and retail investors who would gladly step in at 3.1% and bypass the greedy banks entirely. And finally, the ultimate backstop. If the private market ever truly tried to hold the U.S. Treasury hostage, the Federal Reserve acts as the infinite buyer of last resort. They can simply digitally print reserves, buy the bonds themselves, and force the yield to wherever they dictate.
So the mechanics are bulletproof. We've decoded how the immense gears of the macroeconomy and the bond market spin. We've talked about yield curves, Fed policy, sticky inflation, and the smart money. But the ultimate promise of this deep dive, the reason you are still listening, was to connect this theoretical gravity to your actual physical portfolio. How does the bond market's game of chicken with the Fed actually matter to the NVIDIA stock you bought last week? Let's move to the final synthesis, from macro theory to portfolio reality.
This is the crucial bridge that so many retail investors fail to cross. A lot of active investors, especially those focused on day trading high-growth tech stocks or playing short-term options, are highly skeptical of macroeconomics. They think, why should I care about what the 10-year Treasury yield is doing when the software company I own just released a blowout earnings report showing 40% growth?
And the dossier's answer is that macro is a gravity system for all asset pricing. I want you to explain exactly how that gravity physically pulls down the price of a great tech stock.
It all comes down to the underlying math of how institutional investors value a company, which is the discounted cash flow or DCF model. The core philosophical idea of investing is that a company is only worth the present value of all the cash it will generate in the future. But a dollar generated 10 years from now is worth less than a dollar in your hand today, so you have to apply a discount rate to those future cash flows to figure out what they're worth right now.
And what exact metric do the institutions use as that discount rate?
The long-end bond yield, specifically the 10-year Treasury rate. It acts as the mathematical denominator in the DCF equation. Now, think about tech stocks, AI companies, and semiconductor firms. We call them long-duration assets. A massive portion of their multi-trillion-dollar valuation is based on cash flows they expect to generate 5, 10, or 15 years into the future.
So let's connect the dots from earlier. If the macro environment dictates that supercore service inflation is structurally sticky and the Fed is forced to keep rates high for years, then the 10-year Treasury yield stays high.
Yes. And mechanically, if you put a larger number in the denominator of a fraction, the final result shrinks. High sticky inflation means high bond yields, which mechanically puts a heavy ceiling on the price to earnings, or PE, multiples of these long-duration tech companies. Even if the tech company executes perfectly, even if they hit every single earnings target, the macro gravity will mathematically compress its valuation. It's called multiple compression. You can be 100% right about the company's amazing new technology, but still lose 20% of your money because the macro environment crushed the valuation multiple.
That is vital to understand. You aren't just betting on the company, you are betting against the gravity of the bond market. Now, the dossier takes this a step further and specifically targets the impact of this fragile macro environment on options strategies. If you're listening to this and you actively trade, you know that selling puts, specifically cash-secured puts, has been an incredibly popular, almost euphoric strategy lately to generate weekly income.
And in a stable, low-volatility bull market, selling puts works beautifully.
Yeah.
When you sell a cash-secured put, you are acting like an insurance company. You agree to buy a stock at a certain strike price if it drops, and you collect a cash premium up front for taking on that risk. The higher the implied volatility or 4V of the market, the juicier the premium you collect. It feels like free money.
But the dossier issues a massive warning here. It says that executing this strategy in a highly fragile macro environment like the late-stage yield curve inversion we are trapped in right now in early 2026 is incredibly dangerous.
It is the absolute equivalent of picking up pennies in front of a speeding steamroller.
Mm.
Why? Because the macro setup right now is hyper-fragile. The entire market is constantly oscillating day by day between euphoric hope for rate cuts and sheer panic about a looming recession. In this tightly wound environment, a single piece of bad macro data, say, a shockingly high supercore inflation print or a terrible jobs report, can cause a massive instantaneous downward gap in high beta tech stocks.
So let's picture the retail trader. They sell a put on a volatile tech stock on a Tuesday, collecting a quick $300 in premium, assuming the stock will just bounce around its normal range. But on Thursday morning, a bad inflation report drops. The macro shock hits, algorithmic trading takes over, and the stock gaps down 25% at the opening bell.
And because you sold that put, you are contractually forced to buy the stock at the high strike price, absorbing a massive, devastating loss that wipes out an entire year's worth of those $300 premiums. Understanding macro doesn't give you a crystal ball to predict the exact day the market will crash, but it acts as a highly sensitive risk radar. It tells you when the systemic fragility is simply too high to justify collecting those tiny option premiums.
But wait, this brings up a philosophical dilemma. If we use this macro radar to decide when to stop trading options or when to sell our tech stocks and buy bonds, aren't we just engaging in market timing? And isn't market timing famously impossible for retail investors to get right?
This is perhaps the most critical distinction to make in portfolio management. The dossier heavily differentiates between market timing and dynamic asset allocation, which is sometimes called macro rotation. They are fundamentally different philosophies of risk.
Let's clearly define the difference. What is the trap of market timing?
Market timing is an ego-driven binary gamble. It's all in or all out. You look at the inverted yield curve and predict the market will crash on Tuesday, so you sell 100% of your portfolio on Monday and sit entirely in cash. Then you try to predict the exact moment it bottoms out 6 months later so you can buy back in. To succeed at market timing, you have to be right twice, selling the exact top and buying the exact bottom. The mathematical probability of consistently executing that over a 30-year investing lifetime is virtually zero.
So if market timing is a fool's errand, what does dynamic asset allocation actually look like? How does a listener apply this right now?
Dynamic asset allocation isn't about predicting absolute tops and bottoms. It's about fluidly adjusting your portfolio's sensitivity to risk based on the macro weather report. We call this adjusting your beta to optimize your Sharpe A ratio, which is your risk-adjusted return.
Give me a tangible, real-world example of what that looks like in a standard retirement account.
Let's say you have a 401k entirely invested in a high-volatility pure equity ETF like VOO, which tracks the S&P 500. You are driving fast. Now, you monitor the macro data we've discussed today. You see the yield curve rapidly uninverting. You see corporate labor hoarding starting to break down. You hear the Fed signaling that they are willing to inflict pain. You don't panic. You don't sell everything and go to cash. Instead, you rotate a portion of your funds, say 30% or 40%, out of the pure equity ETF and into defensive or fixed income ETFs like ALLW, which are mathematically designed to absorb economic downturns.
So what does this all mean? It means you are still invested. You are still participating in the market if it goes up, but you've actively chosen to put on a seatbelt because the radar shows a storm ahead. Macro doesn't tell you what NVIDIA's stock will do tomorrow at 10 a.m. It tells you if the entire market is fighting a structural tailwind or a Category 5 hurricane. It's the difference between gambling your life savings on black and wearing a seatbelt on the highway.
If we connect this to the bigger picture, the entire goal of this macro awareness, the reason we analyze supercore inflation and bond duration, is to prevent catastrophic drawdowns. Let's reinforce the brutal, unforgiving math of drawdowns. If your all-equity portfolio suffers a 50% loss during a Fed-induced recession, you do not just need a 50% gain to get back to where you started. A $100,000 portfolio drops to $50,000. To get back to your original $100,000, that remaining $50,000 now needs to grow by 100%.
You have to double your money just to break even. That could take a decade.
Exactly. Limiting that initial drawdown, say, using macro rotation to contain your loss to just 15% during the crash because you rotated into defensive assets, is the absolute, mathematically proven secret to long-term compounding wealth. You survive the storm with your capital intact, allowing you to buy cheap assets when the cycle resets.
And that perfectly encapsulates why we spent the last hour digging through these sources. We've covered incredible ground today. We started by demystifying the inverted yield curves and exploring the 2022-2024 mystery, where long-term debt and fiscal dominance acted as a suit of armor against a recession. We looked at how the Fed's rate hike transmission was blocked by grease on the brake pads, inadvertently making the wealthy even richer. We dissected the incredibly sticky nature of supercore inflation and the terrifying mechanics of a wage price spiral destroying the lower class.
We translated the Federal Reserve's academic language to understand their cold, calculated willingness to induce a recession to save the fiat currency. We explored the brilliant duration arbitrage of the bond market, and finally, how to use all of this complex theory not as a crystal ball for market timing, but as a practical risk radar for dynamic asset allocation.
It is a massive framework to digest, but once you see these gears turning, it fundamentally changes how you look at the financial news, your grocery bill, and your portfolio. But before we sign off, I want to leave you, the listener, with one final provocative thought to mull over, something that builds on the logic of what we've discussed today, but looks out toward the horizon. Earlier, we spent a lot of time talking about Baumol's cost disease, the idea that service sector inflation is permanently sticky because you cannot automate a haircut, and a string quartet cannot play Beethoven any faster. Services have historically never benefited from exponential technological leaps.
That has been the unbreakable macroeconomic consensus for over 50 years.
But if we project 5 or 10 years into the future, looking at the absolute explosion of generative AI, large language models, and advanced robotics, will this new technology finally be the thing that breaks Baumol's cost disease? Think about it. If an AI agent can instantly write a flawless, complex legal contract that used to take a team of lawyers 50 billable hours, if a neural network can diagnose medical scans faster and more accurately than a highly paid radiologist, or if AI can act as an infinitely patient, highly skilled customer service agent, could the cost of human services suddenly collapse the exact same way the cost of manufactured goods did? If AI fundamentally automates the service sector, could supercore inflation vanish? Because if that happens, it would fundamentally rewrite the Federal Reserve's entire playbook forever.
It would completely alter the structural gravity of the global economy we've spent this entire time analyzing. It is the most fascinating, disruptive variable on the horizon.
It really is. The rules of physics might be static, but the rules of macroeconomics are constantly, violently evolving. Keep questioning the consensus, stay curious, and keep watching the data. Thank you for joining us on this custom deep dive into the hidden gears of the economy.